Now, hedge funds are sprouting up everywhere, with young managers receiving lots of money to run them. Here to tell us more is markets reporter Adam Johnson. So, coming back, money is coming back into this slightly riskier area of investment.
It is. What a difference a year makes, Matt. Just next month alone, in July, there are scheduled 8 new funds. They will have total assets of over $2 billion, Matt. You know, it's a big difference from last year when literally everyone was running for the exits, and now people want back in. Who are these guys, and how are they doing it? What's interesting is that a lot of these managers are coming out of banks and hedge funds. They have pedigrees, they have track records, but they want to go out on their own. And why do they want to do that? Well, they want to get paid.
And most importantly, they have connections to money, so
Yes.
they can raise the money, and of course, who doesn't want a fat bonus in a year when a lot of them are getting canceled?
Well, and that's exactly the point. If you're at a bank that can't pay big bonuses, you want to leave. But likewise, if you're at a hedge fund that was down last year and yet you were, say, one of the star analysts, you may also have trouble getting paid because that hedge fund has to get back to what's called a high watermark.
So they're not just leaving banks, they're leaving other hedge
Yes.
funds as well. Let's talk
That's
about the one that's really been the top story on Bloomberg today. You can check it out, by the way, on our website at Bloomberg.com.
Great story.
ROC Capital, or Rock Capital.
Yeah, they will be launching next month with $1.2 billion in capital. What's interesting about this is that $500 million of that capital is coming from Deutsche Bank. I mention it because the founder of this fund was running global arbitrage at Deutsche Bank. In other words, you say, well, I can't get a bonus from you, but can I get capital to start my fund? And clearly, in this case, the answer is yes. So the money, however, does not come without strings attached, and that's a very interesting point. It's part of this mosaic that we're talking about. In the past, Matt, there have been things called lockups. So if you gave your money to a hedge fund, you couldn't touch your money for 2-3 years, let's say. Well, at this point, hedge funds are trying to be more flexible, more entrepreneurial, as some of the capital raisers have said. So they're giving people access to their money, either by not locking it up for years at a time, or by, in the case of Deutsche Bank and ROC Capital, actually creating a separate fund within ROC so that they will be able to monitor their money specifically.
But not quite as exposed on their own balance sheets.
That's correct.
This sounds very familiar.
Off
Can you
balance
say,
sheet?
Civ? Listen, I want to just, while I have you here, I want to quickly touch on some headlines, a story that you have been covering in the past. The Obama administration has turned down a request by auto parts suppliers for up to $10 billion in new aid. This is a story coming from the Wall Street Journal. You have done stories on Borg Warner, the big turbo maker, and other auto suppliers in the past. So it'll be interesting to see how this hits shares of TRW, Borg Warner, some of the other auto suppliers. Right now, though, I want to get to our hedge fund guest. Also, while I have you here, Adam, not only are new hedge funds starting, but the number of fund liquidations are falling. Hedge Fund Research reporting today that 376 funds liquidated in the first quarter. That's down 52% from the previous quarter, which was a record. Joining us now with more is Ken Heinz, president of Hedge Fund Research. Ken, let me first ask you about the story Adam's talking about here. It makes sense, looking at your numbers, that we're now seeing these new hedge funds sprout up about $2 billion, Adam telling us, coming into 8 new funds.
It's absolutely consistent with the trend we've observed in the last 8 or 10 weeks of continued increase in risk tolerance that investors are exhibiting. And again, just to be put this in proper context, that's coming off a historical extreme that we observed in 2000 and into the end of 2008, with Treasury bonds, especially short-dated ones, reaching the lowest yields that have been observed in a long time. I think that, as you point out, we saw a 50% drop in the rate of liquidation. 200 of the 376 liquidations were actually fund-of-funds liquidations, indicative of the continued trend of consolidation there. And we also saw an increase of tripling in the number of new launches in the first quarter over that of which we saw in the very volatile fourth quarter of 2008.
We do see, not only new hedge funds popping up, but also new products that help investors that maybe don't have $1 million, $5 million, $10 million minimum participate in hedge funds. Can you see that this is more than just a blip? I mean, are investors really coming back to risk here?
Yeah, a couple of things on that. I definitely think that performance is attracting investors as it should. I mean, what we've essentially seen in the first 5 months of 2009 is equity markets recover early year losses to be essentially unchanged right here. Over that time, we've seen a gain of about 10% in the most broad-based composite of the hedge fund industry with stronger areas of performance. I know previously you were talking about energy and basic materials, a little bit about emerging markets. Those areas have been some of the strongest areas. Convertible arbitrage also posting a gain in the neighborhood of 27-28% in the first 5 months of 2009 alone. I think that, though indicative of some of the structural changes that are coming out of the consolidation we have observed in the last year, is that you have seen increasingly the institutional standard that the industry is adhering to is that of investor transparency. And everything about that is really permeating the way that the trends are playing out and the way that it will play out not only in 2009, but in years to follow.
Well, in fact, Ken, that's an interesting tie-in. So this new fund where Deutsche Bank said we want to see our money segregated from the rest of the fund, you think that's probably something that we'll see more of, in fact, it sounds like. Is that right?
Transparency is not a new concept. I mean, it's something that has been available to investors for a number of years, but I think only recently have investors really come to appreciate the benefits that transparency affords them. And we are seeing a significant increase not only in investor interest in receiving that transparency, but also in the willingness and the flexibility that managers have in offering those type of arrangements to investors. And I think, as I said, that will characterize 2009 and future years for sure.